Good morning, everybody, and welcome to the latest in the IMAP series of webinars. This week's webinar series is on one of the most significant issues that faces portfolio managers and advisors throughout the world, but particularly here in Australia, the implications of interest rate rises. We're tackling this topic, as we usually do, in three tranches. Today, we're going to be talking about macroeconomic conditions. On Wednesday, we'll be talking about implications of interest rate rises for specific asset classes. And then on Friday, we'll be talking about the portfolio management implications of that. We're fortunate enough to be joined as the moderator for the whole of the series by David Cohen, Head of Research for Evergreen. And I'll leave David to introduce each of our presenters and today's presenters from Morgan Stanley and BlackRock. But before I hand over to David, let me just talk a little about some of the upcoming events. Tomorrow in Melbourne, we'll have the second of our portfolio management conferences, in which we'll address a number of the issues that we're going to be talking about today and more beyond in detail. It's the time for Managed Account Awards, and I'd encourage you all to join the awards and to enter one of the 5 asset class categories, or the Licensee Award, or Innovation Award, or a new category for us this year, ESG portfolios. And then just a little advance notice that in June, we'll be running the Advisor Roadshow. If you want to ask a question through the course of the session, use the Q&A button at the bottom. It's now my pleasure to hand over to David Cohen to act as moderator for this week's webinar series. Thanks, David.
Thanks, Toby, and good morning, everyone. We're very lucky to have 2 distinguished speakers today. First, we will hear from Alex Ventelon, who is Head of Research for Morgan Stanley Wealth Management Australia, where he's developed an IMAP award-winning multi-asset investment approach and has responsibility for producing investment strategy research and providing implementation advice to Morgan Stanley clients. After Alex will be Craig Vardy, the Managing Director and Head of Australia Fixed Income at BlackRock. Craig was previously a cash and fixed income portfolio manager at Barclays Global Investors before the 2 companies merged in 2009. And with that, I'll hand over to Alex to begin his presentation.
Hi, David. Hi, everyone. Thanks very much for having me today. Very topical subject indeed. From Morgan Stanley's standpoint, I think it all starts with the geopolitical development in Europe, as we can see on the next slide. But prior to that, what I wanted to say is that as we were going into this year, we were already expecting this year to be a relatively challenging year in terms of inflation backdrop and sort of monetary response against that. So with the latest geopolitical development in Europe, if anything, they've made things worse in terms of inflation pressure. We were expecting some form of relief this year as supply chain disruption comes off, but this has been more than offset by the fact that we've seen that really spike in energy prices and in particular the Brent price spiking by more than 40%. So what I wanted to try and illustrate here on this chart is the fact that as a result, inflation expectations have come up. You can see in the US the break-even compared to prior to the troubles, as I would like to call them in Europe, they've come up. So what we are expecting that this is a very, very heavy impact in the next 12 months, but this is going to be still a sizable impact on the medium term as well. The market is basically telling us that a lot of disruption coming out of the limited supply from energy markets in oil and gas will flow through the real economy and have a longer lasting impact. We don't know when we're going to get that supply back on the markets. And those very high energy price, we believe they're going to impact global growth. And the crisis as a whole is going to impact global growth through higher energy price, higher volatility, and tighter financial conditions. Financial condition is the broad state of the capital markets in terms of having access to financing. It's very important for investors. It's also very important for the real economy, and that's why the Fed has flagged that numerous times. So when financial conditions deteriorate, as they have been, this is something that the Fed must acknowledge, and this will very much influence their policy, as they don't want to be too restrictive in an environment where financial conditions are tightening a lot already, and this could eventually feed into slower economic growth. So as a result, we have downgraded our forecast across most regions, but it's very important to make the statement that we're still expecting this year to be a rather positive year for global growth in Australia as well. I'll just come back to that. So moving on to the next slide. And that's probably the key topic of today is what we call the tricky handoff. And what we mean by that is that we were expecting this year to be a transition year between a growth, GDP growth that was massively subsidized by easing on both the monetary and the fiscal front, to a growth that would be more self-sustaining this year. Unfortunately, one of the key parameters was to keep inflation under control, and the opposite has happened. The headline inflation is running at more than 7.5% in the US, and it's become a political issue. Compared to our prior forecast, what's happened is that we are now expecting those inflationary pressure, as I touched on, to be stronger throughout the year. Keeping in mind, we are expecting Brent to peak at 120 US dollar in the third quarter of this year, and that would lead to core inflation in the US to achieve a 3.4%, so well in excess of the Fed target. And the key implication as well is the return to normal in terms of inflation around the 2% mark is a 2023 story in the US, not a 2022 story. In Australia, we're witnessing a similar acceleration in inflation, but the range is just different. The December quarter inflation was strong. We're expecting the March quarter to be extremely strong as well, and an inflation that should come in at 3.6% for the whole year in terms of December number 2022. Here as well, we are expecting normalization of inflation, probably a bit more gradual in Australia, and to be mostly a 2023 story. So the key implication here is that those higher than expected inflationary pressure will push the central banks to act more aggressively than what was previously expected by the market and the central bank themselves. So moving on to the next slide. What we wanted to show here is that the central banks are now expected to tighten monetary policy materially and sooner than expected. So they will have to reverse their lower ever policy rates and their largest ever balance sheet in the next 12 months. So in the US, we are expecting the Fed to deliver about 150 bips of tightening in 2022. That's about 6 hikes for this year, and another 100 bips in 2023, which should get us to 2.6 to 5% cash rate at the end of next year, and we expect this is about the neutral rate in the US. So back to neutral, and having built a sufficient buffer in the US should the economy fades to then be easing. Interestingly enough, the markets is of the belief that in 2024, actually, the Fed will have to reverse course because the tightening will have been a bit too strong by then. There will have been a deterioration in demand, leading to a contraction in economic activity, and the Fed will have to cut rates. That remains to be seen, but that's very interesting to note that right now investors are of the belief that the Fed is behind the curve. It will have to do too much, and that will lead to demand destruction. In Australia, we are seeing, with more tame inflationary pressure, strong growth, and tight labor market, we think the economy is strong but not overheating. And as a result, we should see 3 hikes this year and another 4 next year, taking the cash rate by 1.75 by the end of 2023. Interestingly enough, in our view, we will not be at the neutral rate by then. So therefore, now we are going into a world where we should see structurally higher rates than what we've had in the last 10 to 15 years. And finally, on the last slide, I just wanted to reiterate that despite this more challenging background and this more sort of, should I say, less positive monetary backdrop, we have downgraded growth mostly in Europe, but we still see global growth at 4.4% in 2022 and 3.8% in 2023. These are years where we see above trend growth, and that's very important. We do not forecast a recession, neither this year nor the next. And although there are headwinds to growth, especially in the first quarter of this year, where the pulse is fading, we still expect a capex cycle to take over from the fiscal stimulus. There's a very wide need of investment across a number of sectors around the world. That is also true for Australia. Australia, in our view, is very well placed to outperform most developed markets this year and the next. We have strong economic momentum. The country's a commodity exporter. We have lower inflation pressure as a result, a more accommodative RBA compared to the Fed, for instance. And we are expecting a GDP growth of 4.5% this year and 3.5% next year. And I'll probably stop there and hand it back to David.
Thank you, Alex, and hand over to Craig for his presentation.
Thank you, and good afternoon, everybody. These are certainly very challenging times for investors and particularly asset markets. So navigating through them is particularly interesting. If we look at slide 1, this is really just to frame kind of BlackRock's view around the macro environment. So first major macro theme for us is living with inflation. So the rise of interest rates that we are seeing now is basically anchored in rising inflation. So we expect inflation to be persistent and settle above pre-COVID levels. This is a little different to the times sort of pre-COVID, if you like. Back in December when the view was framed, there was certainly evidence of rising price pressures globally. But the key here for our view on living with inflation is the outlook for real interest rates. So we would expect real rates to remain historically low, which should support risk assets. So the implication for there from, I guess, an asset allocation perspective is to remain kind of overweight equities and underweight fixed income. And clearly to hedge inflation risk means an overweight to inflation-linked bonds. The second key theme for us is cutting through confusion. If anything, the last 3 weeks have only meant more confusion for markets, but the underlying driver, as I've noted, is rising inflation. So there are lots of moving parts to the macro outlook at the moment. Clearly, policymakers are challenged by it. The risks are high around a policy mistake being made here, but right at the moment, central bankers seem to be fixed on inflation rather than growth concerns. So the key here is that we are likely to see interest rates continue to rise. So clearly trimming your overall risk budget, the outlook for risk is probably a prudent course of action at the moment. And lastly, on this slide is navigating net zero as a macro theme. So that looks at sort of ESG climate change implications. We see this as an inflationary story for markets. It's obviously a slow burn, but we think those inflation pressures will start to build over time. What would matter for markets and the outlook as we progress towards net zero is clearly a smooth transition, is a better outcome than a big bang, if you like. So that the steps that are being made now will clearly help out in the longer term. So what does that mean? The most at-risk markets there are clearly emerging markets. They have the most work to do. Inflation is typically driven by the commodity cycle. And so the implication there is favouring developed markets over emerging markets. Slide 2, please. Can we have slide 2? Thank you. That's slide 3. It's the new regime, the quadrants, black background. Slide 3.
Are you seeing that, Craig?
Yes. Yes, sorry, that's the one. So this is really just to give you a feel for expected returns, so equities relative to bonds, and where is BlackRock at the moment. So at the moment, our base case, again, pre-Ukraine-Russia war, was what we're calling the new nominal. Really, this is a macro environment that's still conducive to strong GDP growth, hence a positive equity tilt and mildly high inflation. So nominal bonds continue to sell off. Central banks deal with rising inflation by normalizing the cash rate. So bond yields to gradually rise and real rates to remain abnormally low. So in a nutshell, we get a second consecutive year of positive equity turns and most likely negative bond returns. And that's actually quite an unusual outcome. Clearly, post the invasion, the macro environment has changed. If anything, now we are experiencing risks, certainly around stagflation. That's not our base case at the moment. Internally, we're describing this as more of a stagflationary shock, if you like, and that's especially evident for Europe. It's probably fair to say that the market pricing is non-trivial at the moment around stagflation. If you look at 10-year break-even rates here, so nominal rates versus real rates, they are nearing 3% in the US, which is close to all-time highs going back to 1998. And things like purchasing managers indices are expected to fall below 50. And once you get those conditions in place, you do start to worry about a stagflationary environment. So lower growth, but much higher inflation. Biggest risk to our view is clearly a de-anchoring of inflation expectations. Inflation expectations are clearly starting to be managed now by central bankers, particularly in the Fed, warning of 50 basis point rate hikes, etc. There's sort of evidence around that of sort of managing and not wanting to de-anchor inflation expectations there. Slide 3, please. So this slide, thank you. This one is getting at what's driving inflation. So clearly it's supply side influences at work here. We've had the COVID situation, and which has created a big fiscal impulse there from governments to provide stimulus. So you've got, and on the flip side of that is very much a supply side constraints coming through. So COVID environment created supply side inflation, and now we've had the Ukraine-Russia situation on top, which is again exacerbating inflation. So what they are both cost push inflation drivers. So very much there's a lot of evidence around inflation supply side factors at work here, and clearly the driver of inflation at the moment has been on the good side. So the issue for central banks at the moment is it's actually very challenging for monetary policy to fix a supply side issue, particularly when you throw in sort of the effects of war around that, and also rapid commodity prices rising as well. You know, the Fed and the RBA, for that matter, can hike interest rates to a significant degree, but it's not going to do a lot, you know, to free up things like getting more containers off ships, or you know, decreasing supply bottlenecks around energy. So there's certainly quite a large conundrum there for central banks at the moment. Next slide, please. So the big issue for central banks was a question around, is inflation transitory or is it becoming more broad-based? It's quite clear from both of these charts that the evidence is inflation has become more broad-based. So you can see now that certainly from the good side, there's been a large pickup. The more recent history for central banks is they typically don't respond too aggressively to supply side inflation, barring any second round effects from healthy demand. Now we can see how inflation drivers have broadened, particularly around goods and energy, and also within Europe, there's been a massive increase in energy costs. So the common inflation drivers, these are certainly not lost on the RBA, and the RBA, of course, very regularly point to the fact that Australia is not suffering from the same types of inflation at the moment, but the risk is inflation in Australia does broaden out here, particularly as it filters down towards things like increasing wage pressure. Next slide, please. Sort of a neat way to think about sort of the path for central banks and what they are looking at is financial conditions. You know, if you think right now, you know, financial conditions have been relatively loose. So these are things like policy rates, government bond yields have been relatively low for a long period of time. Credit spreads have been quite tight. Equity market valuations have been high and exchange rates have been quite favourable, and they've been pressured lower by very easy monetary policy. Typically, you know, easy financial conditions have led to strong growth. We can see now that financial conditions are still looking like they're going to be relatively easy as central banks tighten policy. Those financial conditions will start to tighten up, and that's a critical thing that central banks will be looking at. How is this tightening of policy influencing overall financial conditions? They've got their eye on different markets, so the credit market, currency in particular, you know, the absolute level of rates. How is that, and how are markets responding to a tightening in financial conditions as they ratchet up interest rates? Next slide, please. What we've seen today in rates markets has been a fairly dramatic flattening of yield curves. Markets in general, rates markets have moved well ahead of central banks in terms of pricing in rate hikes. And the response of that has been for short rates to move up aggressively, and that's been a flattening of global yield curves. The 2-10 US curve today was at 20 basis points. That is very low for, at such an early point in the hiking cycle. Obviously, inverted curves sort of point towards recessionary conditions. We're still not there yet, but it is a concerning sign that the curves are quite flat at the moment. In the larger scheme, long end bond yields have been relatively well behaved when you think around the Aussie 10-year bond yield of 2.5%, US bond yields at around 210, 215. They are still relatively low in historic terms. So the risk here for us is that long end nominal yields do start to aggressively increase, if you like, and hence the steepening of yield curves. So that's certainly a risk of rising rates that we would see. Next slide, please. I think we might go over that one if that's okay. I think that's it. Now, last slide here is really just to wrap it up is sort of the outlook in terms of an allocation for asset class level. What does all that mean? Effectively, as I've described, we are in an inflationary environment now, so having inflation protection in a portfolio is important, and generally you get that through being overweight inflation-linked bonds. we still believe in a risk-on, if you like, environment anchored by low real yields. So hence that's pointing towards more overweight towards equities and underweight generally developed market bond yields. So I might leave it there.
Thank you both for your presentations. So we might start the Q&A session now. Craig, perhaps I'll start with you for a question that's come through from the viewers. With petrol prices over $2 domestically, won't this lead to higher inflation than the RBA is expecting through higher transport costs?
Definitely. Yes, that's absolutely a risk now from the RBA. And I think there's two ways to think about this. And again, how does a central banker go about solving it? The central bankers can only move policy through using monetary policy. So you think about a blunt tool like monetary policy. Does that actually work in terms of dealing with a supply issue like higher petrol prices? Probably what we have seen recently and what I think we will see going forward in terms of how this offset is put in place, it's probably more on the fiscal side. So what we've seen recently in New Zealand is New Zealand government has actually delivered a reduction in the fuel excise over there of 25 cents a litre. I can envisage a situation where this will probably be dealt with more on the fiscal side here. So, government's cost of living pressures are hitting consumers now. That's recognised by governments, and governments, I think, will step in here and try and address some of the inflation impulse that we see through higher petrol prices. Because, as I said, supply side issues, high oil prices, it's actually difficult for a central banker to deal with those without crushing the economy and leading to more towards recessionary type effects down the track.
Okay, thank you. Alex, perhaps I can turn to you. The Morgan Stanley forecast of inflation seemed to be lower than the market, which is projecting 4% out to 10 years. Can you perhaps just discuss the divergence there?
Sorry, are we talking Australia or the US?
I believe that was the US.
All right. We've been of the view for a while now that we should see quite a sharp deceleration this year in terms of supply chain issues, and that, in our view, would bring a lot of relief to the inflation, to the goods inflation side of things. With a number of countries coming out of COVID-related restrictions, again, we should see a bit more transportation and manufacturing activity, and that, in our view, will lead to the normalization of inflation. Now, what we've done is that because of the disruption from the spike in energy, we've actually, as I said, pushed our normalization of inflation out to 2023. So even though we're going to see a deceleration this year, we think that the return to normal is really going to be a 2023 issue. And that's accounting for a much more aggressive pace of hike that we are expecting right now. We're expecting 6 hikes. I think that, it's very important in terms of both economists' forecasts, but more importantly, break-even inflation, as we expect, like market-based inflation forecasts, that they tend to be extremely driven by short-term moves in the various inputs of inflation, especially with regards to break-evens. They tend to be very much driven, even the long ones, as I showed, by the changes in the oil price in particular. So there's an element of the market pushing out the disruption to the very long term. We believe that in the end, I think Craig alluded to that in some ways. What's going to happen is that the central banks, by tightening as much as what they're going to have to do, that will feed in lower demand across the board. There will be demand destruction. The key thing for the Fed and the RBA is to manage that demand destruction to be a mild one, i.e. a soft landing, and not a harsh one, which is a hard landing. Actually opening up to a different field of the current thinking is that a soft landing versus hard landing is the key issue right now, because in the past, a number of those late cycle inflation surge driven by commodity prices have led to a recession, because the Fed had to do a lot very late in the cycle, and that's where I believe is really the key issue right now for asset allocators and investors.
And just on that, I mean, how much concern do you have that there might be some sort of policy error? And if there is, does it lead to some sort of stagflationary environment?
Our view, and I think pretty much in line with what Craig was saying, is that right now we're thinking about stagflation as a risk and not a base case, right? We could be falling into stagflation. I'm talking about Australia and the US, more of, in a sort of temporary fashion. We have to recall that going into this year, we had massive momentum in terms of economic activity. So the amount of demand destruction coming out of that would have to be enormous to send us into a prolonged stagflationary environment. What I would say, though, is that the picture is pretty different in Europe and in Asia. That's where they are net importers of commodities, especially energy. Australia is a net importer of energy, but a massive exporter of commodities, and that's a big difference. We slashed our growth forecast by 1% in Europe, but only by 30 bips or so in Australia. So I think we gotta take it with a bit of a perspective. It is a risk that might be temporary and affect negatively a number of asset markets, but we don't believe, because also the energy efficiency of the world has changed a lot, and we don't believe that we could be falling into a prolonged stagflationary environment at the global level.
Thank you. So we've got a question come through from the audience. Perhaps, Craig, I might pass this to you. What are your thoughts on the Bank of England's idea of fighting inflation through, instead of using rate hikes, using cost-push inflation to provide demand pull inflation?
Your voice sort of chopped in and out there, David. I actually missed the question.
So what are your thoughts on the Bank of England's approach to fighting inflation, instead, and I think allowing some form of inflation rather than hiking rates heavily?
Yeah, I think that's probably a wise path at the moment, and I guess central banks obviously look at headline inflation and they look at core inflation. Core inflation tends to be what they focus on the most. So headline inflation, you're going to have a lot of exogenous things that will drive that, and will drive it quite high. And I think for investors out there, and certainly for advisors, we would expect to see some pretty high prints on headline inflation at the upper, not double digit, but certainly high single digit. That looks to be the path to inflation at the moment. And I don't think for central bankers that's really a surprise at the moment. And I think the way you see rate hikes being front loaded into yield curves at the moment, I think that's very much a reflection of the concern around very high levels of headline inflation that we will see this year. the key for central banks is to almost look through that to a large extent and look at underlying inflation. So absolutely strip out, your inflation ex volatile items. So typically things like oil, petrol prices, fruit and veg, etc., things that are causing large distortions, and focus on what underlying inflation is all about, because those are, these shocks will tend to be transitory, right? It might take some time, but the idea here is it is a very kind of high wire act right at the moment that all these central banks are trying to walk. BOE in particular, they seem to be taking a more cautious approach relative to the Fed. The Fed seem to want to get going quickly on rate hikes, whereas the BOE looks to be a little bit on the back foot. But that's understandable given they're within Europe, and there's some big shocks going on, right through at the moment. But from a core inflation point of view, I think what people really need to focus on, particularly here, is the outlook for wages in particular, and the demand for labour as well, and the supply of labour. That will really drive inflation, and the concerns around underlying inflation is making sure those inflation expectations don't get out of hand. And so I think that's more the key so focus on core inflation, and being cautious around the magnitude of rate hikes that central banks are delivering.
Alex, did you want to add anything to that question?
I would agree. I think it's worth highlighting that the core component, especially wages and rents, interestingly, had been downplayed by the Fed throughout 2021, and the Fed consistently saying that they would feel the need to make a noticeable turnaround in their views on the path for rate hikes if they were to see the core component really kind of catching fire. And they were a bit dismissive at the beginning, and then they started highlighting that this was more and more of a possibility. And now we are expecting, for instance, Morgan Stanley is expecting rents to grow about 5% this year. So we're seeing like the numbers going up, seeing wage pressure across the various categories of workers going up as well, above 3% in the US. So the core, it means that there's been a pass-through of inflation between the headline and the core components. And I agree with Craig with the fact that central bankers have stated numerous times that in the end, we expect the headline components to be very volatile and come down. But when there's been a transfer to the core component, it's a much harder job to do for the Fed, because in the end, they have to adjust via demand destruction, and that's very granular because the data takes a long time after the changes in the cash rate to really kick in and see whether that was efficient or not. I guess for Australia, something worth noticing is that our unemployment rates, as very much in line with the US one, has been going down very, very sharply. But the difference between Australia and the US is that here we have a very high participation rate of more than 66.4%, meaning that the job market is very, very tight. The RBA mentioned a couple of times that they believe that as we get closer to 3%, we should really see the wage pressure coming in. And at the moment, it will be very important to see whether we are getting migration back in the country, because that would be a very strong offset. And our view is that it's not only going to run as sort of half pace this year, and 2023 is the year where we see a lot of migration coming through, and that should be a headwind and help cool off those wage pressure feeding into the core component.
And you've painted a picture of a reasonably positive growth environment, but obviously talked about tight labour markets. So how big of a risk is it then that your inflation expectations might be too low and inflation may actually be more persistent?
Yes, well, I think that given we have a supply side issue which will be managed in the end by a demand side intervention, the tools are still in some ways quite broken. The ideal tool would be to put supply of energy and fix the supply chains right away, but unfortunately none of the governments can really do that. As Craig mentioned, we can see a bit more being done on the fiscal side, but I would say that right now, if anything, the risks are probably for growth to be downgraded. My view is more than, if anything, we're looking at downgrades of growth if we spend more time in this environment where inflationary pressure keep building up and the response from central banks is not strong enough. So I'm not expecting we see there is any risk of inflation and growth going up. So the reflationary environment is not going to get any more reflationary. It could get a bit stagflationary for a while, and then we'd be looking at a risk of an economic slowdown and maybe a recession down the track if the central banks do too much on the demand side. So this sort of cycle where we have a very, very strong reflationary cycle, I don't think is really a risk right now. The other thing I would like to say is that as investors, we tend to be very often very focused on the reflationary risk because they are bad for nearly every single asset class except maybe gold and some commodities and currencies. But very often stagflationary periods tend to be short-lived, right? Because in the end, there's demand destruction that crushes the cycle, and then the recession wipes out the excess, and we start out fresh if the central banks and the government do a reasonably good job of managing that. So again, I'm more looking at a growth downgrades if situation was to get worse at the international level.
Thank you. And Craig, we might come back to one of your comments. If energy supply remains restricted, does that lead to structural inflation that the RBA can't ignore?
Definitely. I'd absolutely say that the RBA would not ignore, what's going on the supply side. It's interesting, some of Alex's comments, and, I agree with a lot of them. Often one of the best cure for rising prices is actually higher prices. And that kind of alludes to Alex's point about demand destruction eventually coming through. There are, at some point, substitutes will kick in. Like, we know that from history. If you think about the US, there is a price point which, the fracking community will start to turn on their oil wells because they see profit. The economics work for them to pump more oil out. Does that mean that other regions like, Middle East start to pump more oil once it gets to a certain price point that makes it attractive for them and very profitable for them to pump more oil? So I think, I go back to my comment I made, that often the cure for rising prices is rising prices. And there is a point at which investors, producers, suppliers will step in to start to fill some of the void in supply. Europe is already scouting around for alternatives. What I think this unfortunate episode of Ukraine-Russia has really demonstrated is Europe's reliance on, too heavy reliance on Russian commodities, oil and gas in particular, and the need now to diversify the sources of energy. Again, at the right price point, the taps will be turned on, and so it's clearly front and center for central banks at the moment. That, as I said, politically, it's a difficult situation, particularly for governments facing elections, and we have one here coming up in May. So what does that mean? It probably means handouts, and there's talk about that. but also mean balloon and budget deficits continue to grow wider as well.
And I was curious with one of your slides to see that you were positive on Chinese bonds. Does that imply that China's moving through a different cycle to the other economies?
Yeah, definitely. China is clearly on a different trajectory just at the moment relative to the other major central banks. Inflationary pressures aren't as paramount in China compared to the rest of the world. Hence, you have them easing policy, whereas you have most of the other developed markets hiking rates. So that makes sense for them. They're facing things like a slowdown in exports, for example, supply side constraints. They're still in this COVID zero world, if you like, which has significant implications for them in terms of growth. So they're trying to trade off quite a few things at the time, pointing towards being overweight Chinese government bonds, for example. I think it's a recognition that we probably will see some slowdown in China, which is an important engine for growth for the rest of the world, let's be honest there. And also them trying to underwrite and shore up, their economy as well. So clearly with that backdrop, that naturally points you towards probably being longer duration and overweight kind of Chinese government bonds.
Thank you. We have another question that's come through. Alex, this might be better for you. Obviously, asking what the potential end game for Russia is. That's obviously a very difficult question, but perhaps also tie that into what it means for European growth, whether Europe goes into recession potentially.
All right, I'll try to respond as much as I can. We are, as you would expect, it's a very sensitive topic, so I can't really comment on what our views are as to what the end game is. I would rather comment on the fact that firstly, it's a very fluid situation. So whatever I could be telling you today could be obsolete by tonight, and that's a situation we've seen very often in the past. As well, you and Craig have been across those situations many times in your career. You can prepare for a base case, and that can be shaken up overnight. So we have to be very responsive. We have to keep in mind what's at stake and more focused on what the implications are beyond the humanitarian drama, what the implications are for capital market and GDP growth. So what I would say, what we know, let's start with what we know. What we know is that this is, again, creating a lot more inflationary pressure in a world that was already dealing with very quickly rising inflation, and that's making things just worse. The other thing is, a strong view from our end is that we believe that even if some form of whatever resolution you want to call that, or could be seen as the market, but as a resolution, will not solve the issue, a number of the issues from an energy sourcing point of view and energy reliance, especially for Asia and Europe. So what we are expecting is that basically a lot of these disruptions will stay around for longer. And that's very important in my opinion, because it means that we should remain in a rather volatile environment, a tricky environment for most asset class. And we believe also that there's a lot of, it's a very difficult environment for asset allocators, given bonds are not giving us the safe haven features as they usually give us. And that's, of course, an even more difficult environment for fixed income managers. We still believe that, especially the US bonds are not reflecting the fact that we are going into an environment for the next 10 years where inflation on average will be more elevated than in the prior 12 or 13, and that need to be reflected in the back end of the curve. Probably we're going to see, we need to see the bond yields going to where the neutral rate is, so probably between 2.5% and 3%. We should see the back end of the curve at some point in that area to find a bit more value in bonds. In our view, that's very important, and probably the Australian bonds have done a better job in that sense for now. And that's going to be the trick for us. How do we manage the cycle regardless of what happens there? I say there's two questions. The first one is that how long are we going to stay in there? We don't know, but the answer to that is that every additional day we spend in that conflict creates longer lasting inflationary pressure. That's number one. And then what's the central bank response with the soft landing versus hard landing? These are the two key things we need to address as asset allocators, and that will need that will sort of lead to natural asset allocation decision rather than trying to take a punt of what the end game is. Because as I say very often in my publications, in this sort of environment, you have a lot more chances of making the wrong decision if you change your portfolio entirely right now rather than making a good one. So probably being neutral and trying to put hedges in your portfolio against the key risks is probably the best way to go right now, in our view at least.
Okay, thank you. Got another question coming through around currency. Craig, you might like to respond to this. And I guess it's really just around the US dollar, Aussie dollar exchange rate and how that might be impacted through this sort of environment.
Yeah, it's obviously a very topical question, and as I came here this morning, we saw the Aussie trading over 74 cents. So there's clearly some momentum behind the Aussie at the moment, and that's obviously got to do with very high commodity prices. So our kind of view, local view on the Aussie at the moment is, we do see a lot to like about the Aussie dollar in this environment. Clearly, as a big iron ore producer. Commodity prices are going to remain high for some time yet. But the other positives for the Aussie, we do have a strong local economy, still very strong. The RBA would be very happy with the sorts of things they keep their own, like the unemployment rate, the level of inflation just at the moment, and obviously growth. It's sort of right in their sweet spot. So that bodes well for the Aussie. We certainly see them pivoting more towards his hawkish rhetoric as well. So again, you've got that underlying some interest rate, rising rates, which is also positive for the currency as well, and also a current account surplus, most importantly. So we think the Aussie still looks reasonable at levels. With the RBA looking to hike, we still think there's a little bit of upside in the Aussie. It's a commodity currency. The only caveat around that is in a risk-on environment, the Aussie does well. It's almost like your proxy commodity currency and regional currency. So risk-on, it does well. Risk-off, clearly, it's almost like the whipping boy for the region. So it can come under a pressure if it really does get to this risk-off situation. Clearly, what matters as well is the US dollar and the outlook for the US dollar in particular. Very much currencies are a relative game. So with the Fed hiking, clearly, and some Fed speakers looking to be quite hawkish, that will support the US dollar or underwrite it to some extent. Portfolio flows matter for the US dollar. So again, if it does, if this war is elongated, risk does start to come off, that will probably favor US equities, hence portfolio flows into the US. So again, it's a relative game. Risk off, stronger USD, weaker Aussie dollar, and reverse going the other way. But fundamentally, the Aussie still looks okay around current levels.
does it remain supported if the RBA's rate hike cycle is delayed or later than the Fed's?
I think that's certainly a risk for the Aussie. If we do get this sense where growth is really starting to unravel for whatever reason, and inflation looks to be going hot, let's say they're looking at core inflation and they're starting to back away from wanting to hike rates, then yes, I think that could pressure the Aussie to some extent on the downside. Clearly, it's being helped by the RBA walking forward their expectations of rate hikes. So if that was to reverse, then yes, I think there might be a little bit of negative sentiment around the Aussie.
Okay. Thank you. I think we are coming up close to time, so we might leave it there, and I'll just pass back to Toby. Thank you to both of our presenters, Craig Vardy and Alexander.
Thanks very much, David, and in particular to Craig and Alexandra. Thank you very much for a wide-ranging session today, which covered an enormous number of bases and really highlighted to me the complexity of the issues which portfolio managers are facing into. As I listened to Alexandra talking and Craig nodding or vice versa, I could see that the emergence of a consensus about the path of interest rates and the impact on investment markets is something that's really going to preoccupy portfolio managers this week and into the medium-term future. So on Wednesday, we'll be joined by Amy Patrick from Pendles and Stephen Flegg from AMP, both of whom have several decades of experience. Amy as head of income for Pendle and Stephen as a multi-asset manager. And we'll be looking at the impact of the issues which we've talked about today on individual asset classes and the way in which individual asset classes might be affected by interest rates rising or the other. So please join us on Wednesday. We'll look forward to you to your company. Thanks very much, David, Alexandra, and Craig. Thank you.
Thank you.
Thank you. Bye-bye.